Welcome to this market and economic update. In this video, we'll discuss the key themes shaping markets as we enter the final quarter of 2025. We'll explore why stock market valuations have climbed toward historic levels, what the Fed's recent rate cuts mean for investors, and how to think about policy uncertainty in the current environment. These topics are particularly important right now because markets are sending conflicting signals, reaching new highs, while economic data shows signs of weakness. Understanding these dynamics can help provide perspective during uncertain times. Let's start by looking at where valuations stand today. One of the most important considerations for long term investors is understanding what you're paying for the market. Valuations tell us this by comparing price to underlying fundamentals like earnings and cash flow. This chart shows the Shiller price-to-earnings ratio for the S&P 500, which is approaching levels last seen during the dot-com bubble of the late 1990s. This shouldn't come as a complete surprise. The S&P 500 has climbed 34% since its April low, resulting in double-digit gains for the year. Technology stocks have led this rally, with the Magnificent Seven stocks up 61% since the bottom. It's important to understand what valuations do and don't tell us. They're not market timing tools and don't predict short-term market movements. Instead, they serve as inputs into the asset allocation process. The good news is that not all parts of the market are equally expensive. This creates opportunities for investors with broader perspectives and longer time horizons. Now, let's turn to what the Federal Reserve is doing and why it matters. The Fed cut interest rates by a quarter percentage point in September, resuming its easing cycle after holding rates steady through much of the year. What makes this cutting cycle unique is that it's happening while the economy remains in expansion and markets trade at all-time highs. Historically, the Fed has cut rates in response to economic crises or recessions. This time, they're trying to normalize policy after the rapid tightening that began in 2022. The key driver of the Fed's decision has been the weakening job market. For instance, this chart shows the preliminary payroll revisions. The data suggests that 911,000 fewer jobs were created over the past year than originally reported. The Fed is essentially trying to get ahead of potential weakness rather than reacting to a crisis. For investors, rate cuts typically provide support for both stocks and bonds if the economy remains strong. Finally, let's discuss what recent market volatility and policy uncertainty means for portfolios. After significant volatility driven by tariffs earlier this year, market volatility and economic policy uncertainty have improved. However, as many long-term investors know, periods of market calm can change quickly. Current events like the government shutdown and ongoing tariff discussions could create short-term volatility, even if their long-run effects are limited. For investors, this uncertainty may feel uncomfortable, but it's also what drives long-term portfolio outcomes. The last several years highlight the difference between what investors feared and how markets actually performed. Rather than viewing uncertainty as something to avoid, successful long-term investors recognize it as a feature of markets that creates opportunity. We hope you found these insights helpful as we enter the fourth quarter. If you would like to learn more about any of these topics or discuss how they relate to your specific situation, please don't hesitate to reach out. We look forward to speaking with you.